Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Kate Campbell, welcome to this episode of the Australian Finance Podcast. How are you going?
I'm doing very well today, Owen. How about you?
I'm pretty good. Yeah, we're recording in the studio and we're talking about 7 ways to stay invested even when you're tempted to sell, which for most people is probably most of the time.
Yes. You are going to think at many, many occasions on your investing journey, should I sell? Should I change what I invested in? Should I invest in this other thing someone told me about on the weekend? Oh no, I heard about this other different ETF on a podcast. Am I in the wrong one?
Yeah. And it's easy to, particularly when you're new to investing, it's easy to think that everyone else knows something, or maybe that the journalists are privileged and know something, or even that someone else out there has the answer. And sure, you have to pay them for their secret formula. It's very alluring, particularly when you look at your brokerage account or you look at your whatever, however you track your money, and you see it going down and down and down, and you can't explain why. And then there's equally painful as it gets going up and up and up and up, and you're thinking, can this keep going up? So we'll tackle all that and more. I'm curious, though, where did this episode idea come from?
Well, we have gotten questions every week since we started the podcast back in 2019 of, should I sell my investments? Is there a market crash coming? Should I wait to invest until next year when things are going to look better? And we just keep getting questions like that. And so I thought this is a really good episode to tackle some of the things that people are worried about and maybe some of the ways we can mitigate these or address them. So there's always going to be worries and fears when you're investing, but how can we manage them so you're going to make good decisions for your long-term financial future?
For sure. Sitting in that exact seat, Kate, a few hours ago was a fellow by the name of Scott, and he is a fund manager of 20 years or so. And he was talking about all of these different things. And one of the things that I asked him was, well, what would you tell your younger self? And he's like, just stick with it. Just stick with it. That is the thing that he would have done. And I think that that kind of knowledge, it only comes through time, but it is so easy to get off the bandwagon or get off your investing process. Maybe there's a life event where you stop investing as much. Maybe you get scared off because one of your stocks or ETFs falls, and then you think, oh, this investing thing, it's risky, it's scary, it's not for me. These are all the common emotions. And I think I wrote this in an email recently. It's very well established phrase that the market climbs a wall of worry. So if you think about a stock market chart, it goes like bottom left to top right. Or if you're watching,
with a lot of ups and downs in the middle.
Yeah, and then you see all the little spikes and troughs in the middle. And basically at every single point in time, whether it's up, down, or even just going sideways, you can go and you can just Google market crash and there'll be something for that. Or if you just Google market forecast and there'll be some expert predicting something who has probably like a really good reputation on the line. So there's so many things that sound really good at the time, but then you zoom out and you get perspective.
And any single day that you go on Google, you'll be able to find an article saying the stock market's going to go up this week. Someone's saying the stock market's going to go down. Someone's predicting a crash this month. Someone predicting the next recession. And at some point, all these things will happen. There will be ups, there will be downs, there will be market crashes, there'll be recessions, but that's part of the journey. And the trouble can happen when you start basing all of your investment decisions on whatever headline you're seeing that day.
So we've got 7 ways to stay invested. Hopefully these are little nudges of good behavior that help you keep your ETFs, keep your shares, keep your investment property, and just keep chugging along. And the first one is related to what we were just talking about, which is that over the long term, it's better to be invested. And we've got to understand the data here, Kate. There are a few things that happen during a market crisis. One of the things that happens behaviorally is people feel really lost and they search for answers. So we see a spike of activity like on our media website when the stock market's down versus when it's up. And that's because more people are seeking out the reasons why their wealth is declining. And they think maybe there's some answer online, which is human nature, kind of we just try and find out what's happened. But typically what happens in that moment is you also fail to, unless you have a plan, you feel like you're going nowhere and there's no point of call, so a port of call. And what we find in financial planning is that just by having a plan, even if it's a bad plan, this is the thing, you'll be more confident because at least you know what you could do. So the final thing that I like to do is, market crashes, I like to stretch out the time horizon that I'm looking at. So to go back to the data and say, how many times have we been in something like this? And I think you find that in those moments, the longer you stretch time out, the more often these events happen. Like during COVID, when things were really scary, obviously we hadn't been through a global pandemic like that, at least not recently. But what we had been through was the global financial crisis. We'd have been through the 2001 dot-com bust. We'd been through the 97 crisis, the 91 recession. So there's numerous instances, and every time things have come back. And when COVID happened, I went in search of some really good data on this. The first thing that I found was using 124 years of data. So over that period of 124 years, 20% of those years were negative. So you would have lost money. But the average return over 124 years was 13% for the Australian stock market. Keep in mind, 2 world wars, Cold War, Vietnam, global financial crisis, 1970s crisis, you name it, there's been everything in that 124 years, some of the worst moments of human history, no doubt, and the stock market still went up an average of 13%. But the crucial thing is it doesn't go up every year. There were some years where the stock market fell and then fell again. That's very rare. Typically what you find is 1 in 5 years, as that's what 20% is, in fractions, 1 in 5. 1 in 5 years, you will see the market fall. And then typically 1 in 5 of those again is a bad one. So maybe there's 2 years of negative results. Now that doesn't mean that, bad things don't happen. They do happen, and sometimes it takes years for the market to be returning to what it was. But that, if you hear that data, 124 years, some of those years are bad, that's not me making up the numbers. Is what it is. And I think that is a really good reminder to anyone listening to this or watching this that there are going to be some bad years, which is why we say when you invest in shares and share ETFs and those types of things, have at least a 3-year view, because you could get that 1 year that's a bad year and then you think, oh, my whole plan is out of whack. But if you just take the law of averages, you hold for 3 years, maybe you'll be okay, most likely. I went back during COVID and looked at another piece of data. I looked at the US stock market. And this was at the time we interviewed Brian Feroldi. I don't know if you remember that. We got up at 4 a.m. in the morning.
Was an early one.
Brian Feroldi is the author of Why Does the Stock Market Go Up? I kind of says it on the front of the book what it is.
Explains it really well.
Yeah, and he's also got probably the best Twitter game of any finance person in the world. I think he's got 800,000 followers or something crazy right now. But he's a master at breaking down complex problems. And it was around that time, I remember, I went back and looked at some data that Brian had kind of referenced, but he didn't look at it this way. I just saw the source that he was using, so I went back and looked at it. And I wanted to find out, why does the stock market actually go up? Over that period, over the last, I think, 130 or 40 years, the Australian stock market has been the best performing in the world, number 1 in the entire world. Number 2 is the US market, and number 3 is South Africa. But why does the market go up? And what I found when I looked at 150 years of US data is that on average, companies in the top of the market, so in Australia, that would be the ASX 200. In the UK, it would be the FTSE 100. In the US, it would be the S&P 500 as the major stock market indices, the biggest companies. And what I found when I looked at 150 years was that on average, the profits per share go up between 6 to 7%. It's around about 6.5%. So 6.5% per year. And remember, the stock market is a place you go to get dividends and watch your company grow. Now, if a company pays 2% or 3% in dividends and its profits go up 6.5%, it's no wonder the stock market has returned about 10%. So the longer you invest, what you've got to try and find are just companies that keep growing. And as an index investor, if you just invest in index ETFs and you get the whole of the market, you're going to get that average over time. They won't be the same companies today as they were 150 years ago, a lot of railroads and that type of stuff. Now we've got technology companies, but that's the reason why. So I find the longer you stretch that data out, the more familiar you are with market falls. You realize the stock market doesn't just go up. And you also realize the reason why the stock market goes up is because companies create bigger and bigger profits over time. Not the same companies, but companies that come and solve new problems in new ways or old problems in new ways. And that brings me a lot of comfort, Kate.
The second thing that really helps me when I want to stay invested is just getting rid of as much noise, distraction, temptation as possible when it comes to my investing. Because if you just think 2 decades ago, there were a lot less investment options available, but you weren't getting investment news just dropped on you on a daily basis. If you wanted to know about what was happening with different companies, you had to go search out the Financial Review, or you had to turn on the radio or turn on the TV. But now we just get push notifications on our phone. We get videos on Instagram and TikTok talking about what's happening with the market, what next crash is going to happen. We're getting information without even looking for it. It's just getting fed to us on a daily basis. And that can really feed into why we're feeling like we need to make a decision that wasn't part of our plans. So really, as much as possible, limit the notifications on your phone. So put it on mute or remove the brokerage app from your phone. You don't need to have push notifications coming from all different financial news sites. If you want to look at something, you can just go on to their site or look for that information directly. You don't need to just let it come at you 24/7.
So right, Kate, there's one website that I use a lot for Australian shares, if I'm looking at those sorts of things, which is Market Index. People will be familiar, marketindex.com.au. The key thing is this is a great website for news and data, but the key thing is you can't trade on it. You don't, it's not your brokerage account, but it has more or better data than most brokerage accounts do, and it's free. So you can go there and you can find out what's happening and you can get great news. Another one that's an app, which is not for trading shares, but just, learning and reading and finding out about companies, getting annual reports, is Stocklight, which is a free app. And I think that degree of separation is great because it gives you still the information and the relevant information, but it's not really allowing you to be impulsive. And so removing the final trigger from your phone is simple. I'm probably the anomaly here, though, Kate. I can't remember the last time I bought something on my phone. I feel like I'm one of those people that only have a desktop and don't have a smartphone, but I don't ever place trades on my phone. A lot of it's automated now, obviously.
It's probably good behaviorally as well to actually, if you are going to make that investment, you log in via your computer. It's not just something you can do at the touch of your fingers on your phone.
Yeah, I think and I couldn't agree more. And the key thing is that the best stockbroking platforms, the best investment platforms now are aware that actually making it easy and gamifying things in particular, making things sound like it's sports betting or gambling is actually tragic for your long-term wealth. And so the platforms that do that are the ones you should avoid having on your phone, especially because you don't even realize what they're doing. You log in, the first thing you see is the daily price chart. And the reason they do that is because then you're going to be more impulsive versus you log into your app and it's got a 20-year price chart of the most boring ETF you can find. And another thing, Kate, is social media accounts. I had to get off Twitter. As much as that is a great place for communicating ideas, I just had to get off it. I followed way too many investors. And social media has this, I don't know, I'm curious to hear your thoughts. Social media has this thing where you can curate who you follow. And more often than not, you're following people who you agree with. And so it can either create an echo chamber, in which case, if you're an investor, that's really bad for you. You want to make sure you're getting different people's opinions and different people's views. But then it can become overly negative if you're a long-term investor and you're seeking out people who disagree with you. So I kind of just got rid of them altogether. I don't know if you've ever thought about that.
It's interesting because I would say Twitter was part of my early investment journey. It's how we met and started the podcast. It's how I found jobs in the past. It's how I learned about lots of different financial companies and options available. But it recently turned into a bit of a cesspool. So I got off Twitter. But I also think the challenge with TikTok and Instagram is you're seeing so many people's different lives that aren't necessarily real. And especially when it comes to saving and setting goals, you're getting everyone else fed into you. And sometimes it stops you thinking about what you really want. And it makes you think that you should have this now, or this is a reasonable lifestyle to live when it's partially funded by debt. So I think there can be a lot of harm to social media. I mean, I'm considering just getting rid of Instagram and everything at the end of the year.
Yeah. Oh, that's big.
Yeah, big move.
Well, this brings us into number 3. If you want to stay invested for the long term, which is consider who you're surrounding yourself with. And I didn't even think about this, but even social media is kind of, you might spend an hour a day on your phone or half an hour on Instagram a day, for example. Confession, it's probably more than that for some of us. But you are also surrounding yourself with stimulus from people, like you said, that might not be always genuine or relevant to you.
Yeah. And especially when it comes to finance, if everyone around you is advocating a lifestyle that's funded by debt, is not interested in saving up for things before they buy them or go on that holiday, is not interested in investing or investing in a lot of really speculative things, that does rub off on you, and it does make it harder when you're trying to do those things yourself. And so it's worth thinking, okay, well, who have I got in my life? What kind of influence are they having on me? Are they making it harder to work on different financial goals? It doesn't mean they can't be part of your life. It's just worth thinking about the influence they're having on you. Because if they're talking about going into debt and gambling and cryptocurrencies all the time, how much of an effect is that having on you? And it's worth just questioning those things and going, is that what I want to do? Or is it just what I keep hearing and getting influenced by?
Yeah. I remember when I was younger, I really wanted to get away from people. And I don't mean that in it is a bad way, let's be honest. I just wanted to get away from them because where I was in my life, I knew that they were at a different stage of their life, whether that's like totally, they're going in a different direction longer term, or even if it's just a short term hobbies and interests, that we were just very different. And I recognize that. I remember hearing a quote similar to the one that you've put in our notes here, which is from Jim Rohn, which says that we are the average of the 5 people we spend the most time with. I would encourage anyone listening to consider, who do you spend the most time with? Or if it's with finance and money, who are the 5 people, whether that you know them personally or you follow them on social media, who are the 5 people that influence you with money? Just try and understand that for a second. It's really interesting, I think, when you do that. And surround yourself with great people. And that could be virtually. Like we interviewed Shane Parrish, who's the founder of the Farnham Street blog and the author of book. He wrote the Knowledge Project book, and then he wrote
Clear Thinking.
Clear Thinking. That's the one. Thanks, Kate. And he talks about this all the time. He talks about like the position that you find yourself in is probably the most important thing, not the decision that you make, but the position, because that gives you the decision that you can make.
And if your parents or your friends have had bad experiences with investing in the past, they may project those experiences onto you and be talking about all the bad things that could happen. And, oh, why are you investing? Isn't it going to go wrong? Aren't you going to lose all your money? Shouldn't you have it just in a savings account? Why are you investing in shares? Shouldn't you be investing in property? People are projecting all of this onto you. And so you've really got to listen to what you want and understanding your why, which is actually the next step on our checklist.
Yeah, so understanding your why is so important. So why are you an investor? Why do you have your money at risk? Why do you put yourself through it? Why do you listen to a finance podcast? So many different questions, but I think there's a risk here, Kate. I want to hear you talk about this, but I think there's a risk if you you should be invested, then everyone tells you need a goal. I've always struggled with that because I'm like, well, I don't know what my goal is, but I know that I should do this for these reasons. Does that make sense? So I think this is almost 2 different things. You've got the understanding your why and having a plan, like to reach your goal. I think they're 2 different things, but they're very closely intertwined. Like if I was to ask you right now, what's your why? What would you say?
I invest so I have more choices now and in the future. So it doesn't need to be really complicated. I think a lot of people aren't people that like to set lots of goals, whereas I have it been in the past. And maybe you just need some general direction of why I'm investing, because when things get hard, you need something to hold on to. And if you're investing for your family's future or just to have more time freedom in the future, then you've got something to really hold on to and anchor you when you do see your portfolio fall in value and you remember, hey, why am I doing this? Why am I going through this hard time?
Yeah, that's great. And I think one thing that we've always advocated for is that you don't need, like, sure, we want you to go see a financial planner if you need one, but you don't need a financial planner. You don't need to pay someone to do this. Literally just writing down, why am I investing? Like, why did I put $10 into Raise? Or why did I buy this ETF with Perla? Or why did I open a CommSec account? Or why am I saving for a property? Like, why is that important? Whatever the case may be, just put it down. For me, in the early days, I couldn't really put my finger on exactly the reason why, but I just knew it was good for me in the long term. I thought, if I do this now, 5 years, I'll have more options. And that was enough for me to keep going.
I think that is enough of a why to keep you going.
Well, thank you. Number 5 is automate as much as possible.
Yes.
Do you automate?
I automate some things. I do some things manually with a calendar reminder, and some things just get forgotten, like taxes, until I realize, I've got to do something about it.
Yeah, that's fair enough.
A bit of everything, but as much as I can, I automate savings and things moving in my bank account. So when I get paid, that's able to automatically transfer to certain offset accounts or savings accounts without me having to think about it. I've automated some of my investments. Not everything can be automated, but you could create some sort of system that at least puts a calendar reminder that's recurring, saying once a quarter, time to make those investments.
Yeah, I like it. I really like it. We have a automation course on Rask Education that you and Nick from Perla did. Full disclosure, Perla is a long-term sponsor of the show. And in that, we talk about the things you should automate and things maybe you can get close to automating, like using a Google Calendar reminder, for example. You might be like, car registration or car insurance due this week. And then you put that in your calendar, and it's not, oh, I'm just going to pay it. It's, I will review it because I'll probably get a better deal, at least if I shop around. Or, fixed rate home loan rolls off now. Seek refinance, or whatever the case may be. You can kind of go almost the way to automating, but then this just kind of lets you take your hands off the wheel a little bit and just take emotion out of it. Remember when we had Natasha Eisman, Tash Invests, absolutely wonderful creator and financial thinker. When she came on the show last time, she said, I treat my investing like a subscription. I just pay it like my Netflix. $500 a month, $1,000 a month. She didn't give figures, but whatever it is. And I think as more people embrace ETFs, I think that's what's going to happen. I think more people are going to be like, yeah, it kind of goes up 5 to 10% on average over the next 20 years. That's just what I do. I know I've got to do it. Kind of like your super. Your super is forced investing. And if more people treated it like that, I think the long-term implications would just be way better. Just treat it like Netflix. I just put the money in and it does its thing. I'm not worried about which stocks. I'm just automating it.
Yeah,
just goes in.
And the reason it helps you stay invested is because every month or quarter when you come to make that investment, you're not having to go, oh, what is going on in the market? Should I stay? Should I go? Should I change what I'm doing? It's just, I've got a plan, and every month or every quarter, depending on how much I have to invest, I invest in what I've chosen in my plan. And I do that regardless of what's going on in the external world.
I'll ask you a hypothetical question. If you had to make the choice out of trying to find the best investment every month or just automating one thing, which would you pick?
I'm going to automate one thing.
Why is that? You could get a better return.
Because there's enough choices I have to make in my life. If I have to make a new choice every single month, I'm probably not going to make the right one, or I'm going to get stuck in analysis paralysis because, 1 month's not enough time to choose the perfect next stock or ETF. I'm going to have to research and do all of this stuff. So I probably wouldn't actually do it. If I said I had to pick something new every month, I would probably get stuck in analysis paralysis. 12 months would go by before I'd made a decision on what my next investment is. And by then I've probably got another 10 options to choose from. So I like picking a few things, keeping a really simple plan, but just doing it on a regular basis.
Yeah, like it. Number 6 is ask yourself why you're thinking about selling. And this is really important. I don't do this enough. Well, I had to for like 5 years when I ran our investment membership that picked stocks. That was more important because we would sell more often. I find the decision to buy or sell an ETF is a lot easier. It's like, do I believe in Australian companies? Okay, I buy an index ETF. Do I need to sell this? Probably not. Like I could hold it for 30 years, it'd still be there. Whereas stocks is a little bit more like, maybe it's a bit more sensitive. But the point remains, just stopping yourself and asking yourself why you're doing something. And in this case, why are you selling?
You need just a circuit breaker there before you. If you could automate your computer to come up with a message of why you're going to sell this, what is the plan here before you hit the sell button, that'd be great. But we don't have that in Australia.
I know that I talked about this a little while ago in an email, and I know you've quoted it here in our document that we use for planning these episodes. And I think people will make a mistake in thinking that what they read on social media or in the news is somehow relevant to them. I remember a few years ago, someone that I followed on Twitter in particular came out and said something about the US Federal Reserve, which is the one that sets the interest rates in the United States, like the official one. They said, you can't fight the Fed, and they subtweeted someone else that had this like amazing chart that showed that basically interest rates are going up, stocks could explode. And I was like, oh, okay. Now I actually was a bit annoyed at that because I was like, why are you, like, what does that mean? Like, what does it actually mean? Like, should I be going for cash, or should I be selling everything and putting my money in a jar in the backyard? Or what does it actually mean to me as an individual? What does that mean to me? Then I asked them that question, and they're like, I can't give personal advice. And I was like, well, why say it in the first place?
What's the point of you sharing it? Yeah.
And a lot of the times people don't even know what they're saying when they go in the media, or they've got these big profiles. And the people that receive that information anchor into it so much. And that can be so risky because it may not apply to you. It's different if you and I are talking about long-term investing, Kate, and someone thinks that the market's going to fall, versus someone who maybe is elderly and needs to rely on the money that they've got invested. Maybe that's a different takeaway, but for us, it's like, okay, sure, we'll just write it out in the next 20 years. Very different. So asking yourself why it matters is important. Now, I know you did have one thing in here about loss aversion, which is a great bias to understand. Do you want to tell us what it means?
It's basically that we feel loss more painfully than we experience joy in gaining money. So let's say I invest $1,000 and the market falls and now my investment is worth $800. I'm going to feel that loss of $200 a lot more significantly than if my portfolio rose and it was now worth $1,200. So there's a little bit of a difference there, and it can make us feel like we have to make action when we see our portfolio fall in value. We feel like maybe we've done something wrong or things aren't working as they're supposed to be. Sometimes things are falling in value because they're not a good company. We might have invested in a company and it turns out they've been involved in a very bad corporate scandal and they've destroyed a lot of value in the company. A lot of customers are leaving because they don't want to be associated with that company. So sometimes the share is falling for a good reason and it's worth diving into that more. But let's say we're investing in an ETF that invests in the largest 200 companies in Australia, like A200. If that falls 20%, then we're kind of going, well, what is actually going on with the broader economy? And do we need to make a decision, or is that more part of our overall investing philosophy?
Yeah, that's a good point. And a lot of people get confused between what happens in the economy, like what is the impact of COVID on the economy versus what is the impact of COVID on the stock market. Many people will know, particularly here in Victoria, where we're recording from, that it took a long time to get through COVID as a society. And yet the stock market recovered. It was like a V-shaped. It recovered so quickly. It fell. I think it was the fastest fall in history. But then I think it was the fastest or the second fastest recovery in history. So had you blinked, you probably missed it. Now, that was a very different experience to people that sat through 2 or 3 years of physical distancing, social distancing, restrictions, businesses going down and under, job seeker, job keeper. I remember all those things. That was a multi-year process in the economy. But the stock market recovered very, very quickly. And I think people have a tendency when they read things in the news to extrapolate, well, that's happened in the economy. House prices, have you heard about that? Immigration, have you heard about that thing? And it doesn't reflect what actually happens in the financial markets. So I think that's a mistake. Focus what you can on the fundamental long-term drivers of the stock market, which is the profitability of companies. That's a really important consideration. Now, the 7th item on our list for helping you stay invested is to consider when and whether you'll re-enter the market. So we started at this show, Kate, by saying that over 150 years, the Australian stock market is the best ever. We've started with saying over 150 years, the US market has companies that grow and become more profitable over time. Over 50 years, virtually every stock market has gone up, right? If you start with the cold, hard data and you believe that that is true because that's literally the data and what it says, if you decide to sell out now, the question must become, when are you going to come back in? Because you know it's the best thing. It's performed better than property. It's performed better than anything. When are you going to come back in?
What are you going to do with that money instead?
Yeah. Where is the money going to go? And so if you have a real reason, like, I'm retiring, I'm going to need to put some money in cash, or I'm going to help the kids out with buying a car, or I want to go to Europe, or I don't know, maybe there's a medical event or something like that. Sure, there's a reason that you would sell. And those are perfectly respectable personal finance reasons that you would sell. They're lifestyle reasons. But when it comes to actually investing in your strategy, when are you going to come back in? Because, there's a famous saying from one of the best fund managers in human history, which is Peter Lynch. He's the guy who wrote One Up on Wall Street. And I'm going to paraphrase it because I don't know the quote exactly off the top of my head, but he said something along the lines of, more money has been lost waiting for a stock market crash than in the stock market crash itself. Because people take their money out, they put it into a bank account, and it sits there earning, 3 or 4% after inflation, 0%. Meanwhile, the stock market's gone up a bit. And even if it falls to a higher level. And I think that's the key thing. If you are going to sell, when would you get back in and why? And if you can figure that out, well, maybe you have conviction and that's okay. But unless you know why you're going to come back in, more than likely it's going to be a mistake.
I've spoken to investors in the past when I worked in a customer support role, and they would keep repeating the same pattern. They would sell when fear was at its highest, when the market had well and truly dropped, and they capitalized losses. They'd lost money and they'd locked that in. And then they waited and waited and waited until things felt better, until they started seeing really positive news stories. And then by then, the market had risen substantially and they got in at, well, we could say the top, but the market had climbed significantly. So they bought in, say they originally bought in for $100, they sold at $80, and then they bought in at $130 or $40. So they're losing out on both sides. They're losing money when the market fell because they sold, and they're losing money because they missed out on their $100 growing to $140 because they waited. And so many people I speak to get stuck because they want to jump out when it's scary, but then they don't have the confidence to get back in for months or years after that.
That's why the habits are so important, isn't it? Like right now, caught up with Brendan Malone from Rask the other day. We just carpooled back from Brisbane to Gold Coast after a Ladies Finance Club event. Shout out to Molly, so much fun. And we were talking about, his is a micro investing platform. Like Rask is where you can round up your money and whatever. And he was saying, you know what? People are still putting money in. Because with that platform, you only need $5-10. You can buy a coffee and you get the 30 cents put into your ETFs and whatever. Versus most of the people in Australia right now are feeling the pinch of their cheese going up in price, their electricity bill, everything's gone up in price, their mortgage, and so their rent. So they don't have as much disposable income to invest. But the key thing is that, you stay invested and you keep the habit, because it is a habit that forms over time. A very bad habit is to sell based on emotions. It's gone up, therefore I sell. It's gone down, therefore I sell. Like that is an emotional decision. There's no real logic behind that. And I think that's very different to having a financial plan. If this is going to happen, then I'll do that. Like you've done it in the past with a very objective mindset. I think that's quite different. But I think the important thing for this is just knowing if you do decide to sell, if you do get scared, when will you come back? That is the key thing. So just to reflect on the 7 things that will keep you invested, or at least help you stay, is when things get a bit panicked, stretch out your time horizon and think over the long term, what does this mean for me? Look for the actual data. Don't just take a headline and run with it, because it's your money at the end of the day. You don't want to do that.
And if you really want the exact data and someone who gets in the weeds of it, I would recommend the book Just Keep Buying by Nick Majuli. And we've also done a podcast with him in the past. I think he's a data scientist background. He just gets his article of dollars and cents.
Yep, that's the blog.
Yep. Yeah. He really gets into the numbers. So if you are someone that understands something by looking at the numbers, he's the person to follow.
Yeah, great. Yeah, so Nick Majuli, Brian Feroldi, there's the great US creators. Number 2 is remove noise, distractions, and temptations from your life. Like if you've ever had a vice in your life, you would know probably one of the important steps is just trying to make it, like trying to tilt the odds in your favor to have good behavior, removing people, removing things from your life that lead you down that path.
Just like you wouldn't have the honey soy chicken chips just in the pantry if they're your favorite food, you're not going to have the notifications on your phone for your brokerage account.
It's like at Casa del Rask. If you come to our place, you'll find that the fruit bowl is in front of you as you walk into the kitchen, but the snacks
Owen
are up the
hid
back.
the Kit Kats in the bottom
They're
drawer.
up the back, behind the microwave, like up the back. It's really difficult to get to them.
Oh, I thought you were talking about the office here where you hid the Kit Kats.
I didn't do that, but that was a very good move, whoever did that. But the point is, that's a micro example of you're trying to like put friction in front of things that are bad for you and make it easier for things that are good for you. And it's like, you want to start reading, but you're not a reader, put the book beside your bed and promise that you'll read 1 page a night. Then 2 pages in a couple of months, then 3 pages, and all of a sudden you're a reader and it's done. Number 3, Kate, is surround yourself with people that you want to...
Who are going to encourage you on your investing journey, that are going to support you, that are going to go, okay, I totally understand that you can't go out for this $200 meal and that you want to host dinner at home instead. That's great. I really want to support you saving up for your home.
Yeah. And even like a lot of young men I find struggle with this, or older men, in particular, like their mates can't afford to go out and they feel really vulnerable by telling you that. And they're like, oh, come on, mate, you can do it. You know, maybe consider that approach and reconsider that they might actually need help. So you're actually helping them improve that and being okay with that. Number 4, Kate?
Understanding your why. So having some sort of anchor to keep you grounded when things feel a bit scary or you're a bit worried about what's happening in the global economy. Understanding why you're invested and having a very simple investment plan. It can just be one piece of paper where you're just saying, I'm investing in these 3 ETFs for this reason. Every time my bank account gets to $1,000, I'm going to buy one.
Yeah, I like it. So automate as much as possible if you can. Automating is very simple nowadays. I think in 5 years from now, everyone will be like automating everything to do with investing because it just makes sense. You don't need to spend all of your life going through everything anymore. You can just use technology, automate your personal finances with something like Pocketsmith or your own BPay or whatever way you want to do it. And then you can automate your investing. You can automate your tax reporting. It's all available to you. It's out there. If you have any questions on that, just ask us in the community because we'll just tell you the resources that we use. Number 6, Kate.
Number 6 is ask yourself why you're thinking about selling. So really question, am I thinking about selling this ETF, this share, this investment because of something I read on the news today, something my friend told me, my mum told me what I'm doing is a bad idea. Mums know a lot, but they don't always know everything about investing. So I say that my mum's going to get cross at me though. She probably knows a lot more than me.
Yeah, that she does. She's indeed a fountain of knowledge. So I would lean into that. Number 7 is consider whether you'll re-enter the market. And if you agree with us that long-term investing is the thing that you want to be doing for you and your family and for your kids or your grandkids or your whatever, you probably know that you need to have some money invested for the majority of your life. I would say if not all of your life. That's why we have super. So if you do decide to sell now, when are you going to come back in? For what reason? Because that will tell you what you're waiting for, and it will enable you to hopefully, even if though you're probably making a behavioral mistake, maybe you try and add some logic to that and some objective data to back that up. So you do make a better decision in time. Kate, those are the 7 things, 7 ways that people can help themselves towards long-term investing. This has been heaps of fun. You'll find resources and links in the show notes and in your podcast player. Kate, as always, thanks for joining me.
Thanks for listening, everyone.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.